Welcome, welcome, welcome. Good day, Bill. How are you doing today?
Doing well, thanks, Dave. Just warming up after shoveling snow all afternoon.
Fantastic. The snow in Canada, wonderful, wonderful. It's hopefully all of our friends who might be driving today, please be careful, please be safe. If you're at home in the lockdown, please be careful, please be safe. Today we're talking about getting started on investing online. We are not financial advisors. I'm not necessarily going to tell you to go work with a financial advisor either, because it might not be right for you. What is right for you is this something called financial literacy. Bill, what is financial literacy to you?
Financial literacy, I guess, just having a bit more, being able to participate in a conversation and understand what people are talking about. So I guess I would relate it to just, if as we're speaking English and we understand each other, it would be just like if you started to bring in other terms and stuff like that, that I could go in. If I had a degree of financial literacy, I would be able to understand you. The greater the literacy level I have, the more I would understand you. I guess even it'd be simple as like, you and I having a chat about hockey and stuff like that. If somebody came in and they never knew anything about hockey, it would be all like we were speaking another language. So I would relate it to understanding the language, and the better you understand it, the better I guess you'll be able to make informed decisions.
That's an interesting scenario. I never thought it from that perspective. You often bring the hockey metaphors in. That's awesome. It's like if we did have somebody who wanted to play hockey with us, we could try to explain everything to them, or we could help them put on the skates, get the stick, get the glove, get on there, start passing the puck to them, getting them involved in the game. They don't have to know everything about it before they can get started. With financial literacy, it's similar. You can get started with investing. You can get started with understanding numbers, adding, subtracting. Most of financial literacy is adding, subtracting, multiplying, dividing. People in the finance industry tend to try to keep things a little bit secret. They tend to create words and mystical ways and black boxes so that people who are outside of the industry are even afraid to ask questions. So there's a little bit of a game there going on that might not be the most ethical, yet I'm really into teaching kids, teaching adults, working with anybody to enhance their awareness, their understanding, and their participation in their own financial well-being.
Yes.
And so today we're going to be talking a little bit about investing. There's different ways right now. I understand you've been exploring with online. One of the new ways, the young ones are doing it right, left, and center, and that's using mobile apps like Wealthsimple here in Canada.
Yeah. I got a little story for you.
In America, it's Robinhood or Webull. The big established banks, Royal Bank, TD, they all have their platforms to do it. It's highly educational, and they're assisting very much to teach people how to invest, to manage their investments, and to be involved in the markets. So what was your little experience today with Wealthsimple?
So first, for what you were pointing out there, they have a great amount of resources to go from like that rookie stage and then learn from there. So to increase your financial literacy. So I was very impressed with that. So anyways, I'm going through the process, and I did it online through my desktop, getting all pumped up and going through, entered in everything. Oh man, this is easy. This is great. For boomers and stuff like that, no problem. Getting all through, get all the way to hit the last button. And then I remembered you sent me this link. So I realized after I researched your link and everything that I had done was done, that there's a referral program that we both would have benefited from. So my account was already set up and everything was ready to go. And then I realized, I forgot Dave's link. And we would have got a little referral, and it turns out, I guess they provide an incentive for the person who does the referral, and I guess the referrer and the referee both get compensated to help you get going on your investments. So, lesson learned. Slow things down a bit when you get excited.
In Canada,
and then move forward.
Wealthsimple offers $10 to whoever sets up the account and $10 to whoever sends them the link. So it's a way to get people started. It is the way of online. There's tends to be an incentive, an affiliate. There's an opportunity to monetize value, yet also incentivize people to take action, inviting friends, inviting people. So as an entrepreneur, as somebody who's looking to build a community, these are things to be aware of. It's one of the things, whether you have a contest, people want to win a prize, they want to win a painting, they'd like to win something. So the gamification, that's the key word these days, Bill. Online, it's about gamification. The big trend in America right now, they're having a liberalization of gambling, the gamification of gambling. They're having liberation of marijuana. There's a whole liberation of that market. There's a real gamification of transactions with Amazon, transactions with these big players. And that's one of the things to be aware of as we move forward. Yet also to be aware that, yes, you can get carried away a little bit. And that's sometimes what some of the platforms would like you to start borrowing money, start investing money you don't have, and getting that dopamine drip, the oxytocin, the serotonin. This is about the way that we're being rewired to be engaged in these games online.
Yeah, well, definitely, I totally agree with that. The less pain through the process, the more you're going to commit to them.
So so if you're starting to think about your portfolios, or again, different types of plans, you might have a short-term plan, you might have a medium-term plan, 5 years, you might have a long-term plan, 10 years and beyond. What questions might be popping up today? Yes.
The first thing I was looking was sort of, I like tinkering with math. So I wanted to get a better handle. Okay, if looking at the math to figure out down the road when I'm more towards my retirement, if I wanted to choose my goal as, say, getting dividends that would give me 12,000 a year, I was doing math this way and the other way, and just to get an idea of how many stocks I would have to buy of a certain company and that sort of thing. And like, what would be a simple way to run through the math to figure out, okay, where do I need to be? How many stocks do I need to purchase? What percent do I need to, that sort of thing.
There's some great numbers in finance, especially in the finance industry. One is the law of 72. And so if you times the two numbers, so 9 years times 8% per year is 72. That tells you that doubling your investment in 9 years, you will require an 8% compounded return. If you get 6%, it's going to take you 12 years, 72. So that's one little rule of numbers to remember. The other is when you're looking at getting 12,000 year dividend, if you're getting 6%, then again, you're going to need $200,000 invested at 6% to give you 12,000 in dividends. Right. If you're getting 4%, you're going to need 300,000 at 4% to give yourself $12,000 in dividends. So these numbers are really great to have a calculation, have a target. And the way this works in the brain too is when your mind has a goal, it activates the reticular activating system, or the RAS, R-A-S. And it allows you to be really creative. And this even happens when you're sleeping or when you're thinking. You'll have this idea that I want to get 12 grand a year in dividends. And you give yourself a nice time frame. Give yourself 5 years, 7 years to work towards that. Pretty cool, because you will find ways to get that going. And you'll be so surprised, even if you put it away sometimes and you just set your mind on it, that you can get your way there. And so I love the idea right now that there are some dividend stocks right now that are giving you 8%.
Right on.
And so 150 grand at 8% will give you your target.
Yeah.
Now, I'm not suggesting you have all your eggs in one basket. That's the thing. That if you have some dividends at 8%, some at 6%, and some at 4%, you have a blend. You need, again, what's beautiful is now you have a benchmark, about 150 to 250 grand, 150 to 300 grand invested in dividend reinvestment, invested in different types of utilities that could give you your target of 12,000 a year coming back from dividends.
What would you suggest as a maximum number of like the dividend reinvestment type stocks?
Well, it's funny because if you got your accounts with the Canadian banks, for instance,
Yeah.
most of as soon as you register and you buy a stock and it's in there, they'll ask you whether you want it as a DRIP, a dividend reinvestment.
Okay.
So right now, I probably have 12. So
Oh, wow. Okay.
I don't necessarily think you have to have a limit. Yet you can have a focus that you can have key stocks that you invest in that you know you're going to probably keep. Like this year has been interesting. I've planned the whole year that I'm not going to take any money out of a couple of banks, a couple of Bell Canada, Trans Canada Pipe, actually Enbridge. So that's 8%. This is 6%. That's 4%. And so this year, I already know that those companies are going to pay dividends. And that's going to be a nice way that part of my portfolio, I don't really have to think too much about it. I'll look at it. I'll just check it, see if when the payments are quarterly, semi-annually, annually, and have an arrangement with them, yet they can grow with a certain level of what is passive income. Yet I don't believe in full passive income because that means not caring, not taking care. At least be a good caretaker for your investments.
Yes, yeah. So when you choose the drips, what do you like? When do they pay? Is it based on the calendar or based on their fiscal year, or when do they pay out their dividends?
So that's what's beautiful. If you use Yahoo Finance or Wealthsimple or TD America or Action Direct, each of the stocks will have an outline of when is their annual returns, when is their fiscal year, when are their quarterly, when are their semi-annual. And so it will show you, it will tell you when they will be paying their dividends. I believe most of the Canadian banks pay quarterly. And so you could check that out, though. It will tell you very clearly whether they're paying quarter. The one that I recently said to you, FIE, which is an exchange traded fund, they pay monthly. And so it was interesting because Justin was the one who referred that one to me, and they're paying over 7% paid out monthly. And so that's a pretty cool, I just invested in it, and I'm just about to get the first payment from them because I believe the day of declaration is, if you're a holder on January 25th, I believe you get paid January 29th. And so that type of information is available in Yahoo Finance, and it's also available on the platforms that you'll be trading.
Oh, cool.
It is stock by stock. It is different for different companies.
Gotcha. Yeah. Yeah.
So
I was just wondering, is it worth like getting a whole bunch of dividends that pay, that their timing sort of happens that it becomes something is coming in month by month? Like, again, I'm looking down the road here for it. You see money coming in month by month, or is it, or do I look at it, okay, I know once a year I'm going to do this. I haven't really got my head around what I would like to see. I just wanted to know, okay, what are my options?
Well, these are your options. You could have companies that pay you monthly, quarterly, semi-annually, or annually.
Perfect.
It is up to you to set it up. I would be inviting you to get started instead of trying to make it perfect before you start. So get one of them going, seeing the dividend come in, seeing you can arrange it. So there definitely are some people that want to have, because maybe their dividend is a big part of their retirement fund. So they do plan to have different assets paying them in a regular interval.
Right on. Cool.
Great question.
You're the ones, you're keepers. So you're the long-term ones. So for me, I'm, maybe like Disney or Netflix or Google or something like that. I know you've mentioned in some of our other conversations about you'll have something and then it gets up to a certain point and then you sell some off, and then there's certain levels where you buy. What do you use to measure that? Do you have a rule, a philosophy? Again, looking back to our math today, our math lesson, do you do any calculations? So let's say, for example, let's go on Disney, right? So say Disney was at 100 and that was one of your keepers. What would be the point where you would maybe sell some off or keep buying? What would you look at there?
The great question again, Bill. And again, it's a relationship you have with each of these companies. With a keeper, I would tend to have a core position. Now, I'm also thinking about what are the goals. So if you're going to buy, Disney's actually considered a growth stock these days.
Okay.
It's giving a healthy return. And so if you got a core and it's growing, you might not really care too much about the dividend or care too much about where it's going because you want to be part of it. You want the growth. Now, if it has a big jump, you might sell some because your portfolio, you probably don't want any one stock being more than, say, 20% of the portfolio. And so that's what's happened this past year with people who've owned Tesla. It's gone up 8 times. So they originally, it might have been 10% of their portfolio, but because it's gone up 8 times, it's now 30% of someone's portfolio. Somebody doesn't want to have 30% in one company. So you sell a little bit of Tesla and then you put that money into a new holding. And so you have a diversified portfolio. The general rule is you don't want to have any one company more than 15 or 20% of your portfolio.
Okay.
Even on the risk side is that there's people now talking, and we talked a little bit about crypto the other day, or gold or silver, is what percentage of that should be in your portfolio. And I did want to have an excerpt on that today, is that if I was to ask you what percentage of crypto should be in your portfolio, say you have a $100,000 portfolio, is crypto a part of your portfolio? Is gold a part of your portfolio? What does your gut say to that?
I'm very curious about crypto. I think that's going to be something that I would like to have at least somewhere between 5 and 10%. Starting out, as I am right now, the rookie, I would probably look my first goal would be to get to that 5% point. And then, as time goes on, I get more experience, and I would probably look at moving towards 10.
Okay, so here are the benchmarks, all right? For crypto right now, because it's a high risk, it's a high potential return. It's also a potential going to zero. So you don't want to have a lot in your portfolio, yet if you're risk averse like me, you might have 2 to 5% in your portfolio.
Okay.
It is like an insurance, because it's an insurance that the money printing countries in the world are going to go into some type of hyperinflation. Now, there's people out there saying, oh, that would never happen in the States. Well, guess what? It happened in many countries over the years. We had it in Germany. We had it in Africa. We have it every few years. There's a country that goes hyperinflation. The way the Americans are pumping money right now, there is a possibility it could. So having 2 to 5% in your portfolio is like cheap insurance. So for someone like me, risk averse, 2 to 5%. The next is 5 to 10%. If you actually want to potentially trade it, it's volatile. It could be fun. You could actually make some pretty cool money, because if it goes from right now, say 50,000 Canadian to $1 million, that's a 20 bagger. That means your 2.5 grand could be worth 50 grand. That means a 20,000 position could be worth $500,000.
Right on.
That's if things really hit the fan.
The
young ones who are active in this, 10 to 20%, because they've got time to allow it to disappear. If it disappears, they got time on their hand. So some people are saying 2 to 5 if you're very risk averse, yet being totally out of gold or silver or crypto is a little bit naive, that you don't have any insurance. That traditionally goes against what the market goes. It's called beta. It's opposite to what the market goes. 5 to 10 for someone who wants to be active in it. A 10 to 20 for those ones that are wild, wild west, which, again, many of the young people today, they're loving their crypto. They're loving their engagement with it, and they're finding alternative ways to be involved.
That's very cool.
Okay, so nice benchmarks for investors, yet also for people who are planning right now. Again, we said we're not financial advisors. Take this as education. If you want to argue with me, disagree, fine, add a comment, ask a question. We're here to be of service, and that's one of the things we're enjoying here.
Yes, definitely. What else?
Well, your portfolio is, if you have what we did in the first is Have 5 or 6 or 7 companies that you enjoy, that you want to learn, that you want to grow with. That a couple of them that could be because you really love their product, you're a big ambassador and advocate. Instead of just sending your money to them, buying all their products and services, why not own it? And so when you buy something, you're actually going to get a little bit back in either growth or in services or in enjoyment through dividends. So that's the type of Disney relationship. Your banking, you work with certain banks right now. Instead of just paying them the $4 a month in service fees, have an awareness that you're going to be getting some of that back in dividends. Doesn't that make you feel better? This is about abundance. This is about exchange. This is about what's going on, often without you even knowing, yet it is going on. And it's cool when you have awareness of where your flows are going, your flows of money, your flows of service, your flows of intelligence and wisdom. So apply it.
Yes. Yeah. No, I'm all set now. And I get that first purchase done this week. And we'll start from there. So I'm looking forward to it.
What will be your first 1 or 2 or possibly 3 investments?
I'm looking first to focus on the DRIP stuff, the Dividend Reinvestment Program. I'm looking at Enbridge and Bell to be a starter. The Disney might be a birthday present or a Christmas present later on in the year.
That's a great idea. In fact, it's one of the things I did with Justin when he was younger. Is he got some Disney shares, and I showed him the shares and the financial report, and it was really fascinating because again, he got introduced to it at a young age, and as you've seen, he's sort of learned to enjoy it his own way. So you're talking Enbridge right now. Their ex-dividend date, just to inspire you, is February 11th. So if you own the shares before February 11th, which means if you bought them 2 to 3 days before, you will be a shareholder of record, and the company will be giving you your dividend. So their earnings date is February 12th, and their ex-dividend date is February 11th. Their dividend right now is 7.57%.
That's not bad. I like that.
So that could be one that even if you were to put a couple of $100 in, you get started. And if you do decide throughout the year to add a little bit more, that's a nice way for you to do not only a dividend reinvestment, yet you can go on a quarterly small purchase plan, and that would allow you to get double bang for your buck.
Yeah.
No, so let me give you the info on Bell. Bell's ex-dividend date was December 14th. So you're going to have to wait for that one to come around. The dividend yield right now is 6.08. Okay.
That's not bad either.
Yeah. Well, those are both great ways to start a long-term dividend relationship. And then what you got to do though, Bill, is you got to remember the stock throughout the year goes up and down.
Right.
And that's where the dividend yield will go up and down too, because it's inverse to the price of the stock. And that's what many people aren't aware of. And that's where your question about having a core holding, yet throughout the year, if you see it go up, has a big spike, you might sell a couple of shares, take some profit,
right?
Some of that profit and other things. And so that's where a little bit more active management comes into play. And it does allow you to really start to see the patterns, the ebbs and flows of the stock prices. Because again, this market is very dynamic, and when people are selling, that's really when if you have the bravery to buy, you can get some extraordinary gains that way. Similarly, when everyone's selling, that's not the time to sell.
Yeah, sort of go against the flow.
Go against the flow if you can, and if you've got the long-term relationships. It's like if you bought Disney and then all of a sudden everyone started hating on Disney, you might actually be there and saying, "I'll buy a couple more shares."
Yeah. Yeah, no, I was reading, I was doing a bit of research beforehand, and there's a lot. I understand your point that it's considered growth with some of the stuff that's going on and that sort of thing. So especially with the Disney Plus there, with the revenue that it'll be generating. So it seems pretty exciting.
Disney has been a big surprise for people this year, given that so many of their assets have been closed down this year. Yet their stock has gone ballistic. They got a 4-year, basically, it looks like they got 4 years results in their Disney Plus adventure by really being aggressive with it this year, yet not looking at it as a huge negative. Their reporting date, by the way, is February 11th this year. So what you'll see is some volatility around that day.
Okay.
Now, that volatility might be volatility as in a spike up, or volatility as a spike down, which could be an opportunity to buy. So either way, what would be an idea is if you wanted to invest $1,000 in Disney, maybe get started this week with 250, or like right now their shares are 169 bucks. You could even start with a share or 2 or 5, and then depending on the results, you're either going to make some good money, or you're going to maybe have a buying opportunity.
Right. Cool.
So that's
interesting.
One of the things you can do is with Yahoo Finance or any of the platforms you're using, whether it's Wealthsimple or TD America or Action Direct, you can start to see when they're giving their results. I do invite you to go online, see the way they do their annual report, the way they're doing their virtual meetings. Read the first 5 pages of Disney, and you'll get a really great idea of what they're doing in their business for the next 5 years. And that, as an entrepreneur, also can give you some great insights into following the trend of the big guys will allow you, especially now that you're doing more online, your podcast, you're doing business in the States, watching hockey and reporting on that. Being involved in that industry might be a real fun thing to do.
Yeah, oh, definitely. Reading up on that stuff is it definitely gives incentive. That's for sure.
Fantastic. And so what will stop you is probably this thing called fear, fear of making a mistake, fear of, with one of our favorite phrases, practice makes what?
Progress.
Progress, folks. It's not what has been drilled into our heads since we were kids is practice makes perfect. No, practice makes progress. And if you go and in the next month, you put in 2 or 3 of your first stocks and your holdings, and then you look at every quarter for the next year, you're going to make a little bit more purchase. You're going to actually be able to dollar cost average. And I have a feeling that in a year, whatever you invest, you're probably going to be higher than it is today. Yet if it's lower, then guess what? It's a buying opportunity.
Keep buying. Yeah. That's
and
cool.
So if you have got a 5-year outlook or a 7-year outlook or a 10-year outlook, that's one of the ways that, again, Warren Buffett has created his wealth. This is the strategy of Peter Lynch. This is the strategy of medium to long-term investing. And hopefully it'll work out for us. That's, again, one of the things that whenever you're working with a financial advisor, they're often telling you about 8-year returns, 10-year returns, which is quite different than what we're seeing in the market right now. Because right now it is so volatile. There's so much new information. There's options activities. This past week has been crazy with what's called going after the shorts. This is a group on Reddit that have come together, and they've looked for companies that are drastically shorted in the market. The big one this week has been GameStop. That stock going from 60 to 70 to 120, 130, back down to 70, all in a day. And it's been crazy. And that's one
Didn't they also tinker with BlackBerry?
BlackBerry's on that list right now. AMC's on that list right now. Nokia's on that list right now. Macy's is on that list right now. So any of the companies that their finances weren't so good, the shorts would go after them. And what they do is they sell it with an intention to buy it back lower. And in fact, some of them get greedy and want to make those companies go bankrupt. So what's happened is the Reddit crew, which are a lot of the day traders, have come together. And if they see a company that GameStop, they were sold, 140% of their shares were sold. So that means they were just bashing it. So what they did is they almost came to the rescue, like Robin Hood, and they bought up the shares. And as it went up, the people who shorted it had to buy it back. And that's why we got double the momentum to buy and then triple the momentum to buy. And they actually, one of them went bankrupt, $2.8 billion they lost. And so that's some of the activity that's going on in the marketplace right now as we're getting into some real technology. Because the idea here is that phone that you have right now, this like device is like a supercomputer. 15, 20 years ago, people had to have 5 screens in an office, in a trading room to be able to do what you can do today on your phone.
Yeah.
That is the type of power that we're wielding. And then when you're talking about leverage, many of the Bitcoin, cryptocurrency houses, some of the platforms in the States are giving their investors not only $100 to join or $10 to join. They're saying, oh, if you want some credit, we'll give you credit, 5 grand, 10 grand, 50 grand, and we're only going to charge you 1%. So these people are creating a bit of a bubble in a certain area of the market.
Yeah.
Can we all be damaged? Yeah, it will often lead to volatility. Yet that's something that you'll learn to deal with volatility, because this idea of being afraid to do anything or practice makes progress, I have a feeling I know which one you're going to do.
Yeah, no, I'm looking forward, man.
So as we bring this to a close, any last question you'd like to share or comment on financial literacy, on getting started?
I'm just to confirm over our last, to do the dividend reinvestment program, I'll need to go through one of the banks, not the Wealthsimple. The Wealthsimple will be more my non-drip related purchases that I want to do.
That would be my understanding today. See, this is,
okay.
It's a dynamic world. Yet what I've been advised most recently is that Wealthsimple doesn't have the drip structure.
Right.
Okay? So if you want to start with one of the banks, they'll ask, one of your questions will be, do you want to have a drip? So immediately when you buy it, it will be registered for the drip. And instead of paying you the dividends in cash,
right,
they will purchase shares for you without a commission. So it's quite a nice, sometimes, again, depending on the shares, they'll ask you, would you like to make an additional contribution? And that won't be charged a fee. So that's something you'll also have to check with them. Yeah, that's nice. If say you're getting $50 in dividends, they might say, would you like to add to it? So you might put another 50 so you can buy twice without the commission. So that's a nice add that you can check with your bank.
Yeah.
Wealthsimple might be more fun for some of your crypto, because they do have a crypto component to it. Mm-hmm. You can send the money into that. You can start trading Ethereum, Bitcoin, and that would be one of the ways that you could get started with that. You can have a day trading component, and you could have your TFSA, and you could also have your crypto transactions.
Yeah, that's right. That's on my agenda to get organized over the next week, or organizing the TFSA and all that sort of thing. But no, I'm going to have that thing done by the next time we talk.
All right. Well, I look forward to it. And then next time we'll have a chance to talk about any experience that you had with it. This idea is that we're looking for financial literacy, welcoming any questions. We're also looking for perhaps doing some fascinating trades and investing. So, yet we are not financial advisors.
Exactly.
This is education. We do invite everybody to check out our page at Continual Shift on YouTube, on Instagram, and Meet Up Canada Startup. With that, I think I'll bring it to a close today, Bill. Thank you so much for your time.
Thank you, Dave. Great as always. Thank you very much.